Who truly owns the money? This question didn't begin on Wall Street. It emerged long before marble floors and glass towers, even thousands of years earlier. In ancient Mesopotamia, Egypt, China, and the Greek world, wealth wasn't defined by coins. It lived in grain, livestock, and precious goods. People needed a safe place to protect what they valued. And surprisingly, the first banks weren't companies. They were temples, the most trusted places of their time. Priests kept records on clay tablets, stored harvests in guarded warehouses, and issued receipts that could be used in trade, the earliest forms of money. Trust wasn't just spiritual, it was financial. But wherever wealth gathered, opportunity followed. Farmers needed seed for the next season. Merchants needed goods to trade. Rulers needed supplies for war. And so temples and wealthy traders began lending the goods they stored, expecting a little more in return. It seemed reasonable. If you take the risk, you deserve the reward. Yet this simple idea became the foundation of the financial power structure that still shapes the world today. Over time, banking moved out of temples and into the hands of professional keepers of money, goldsmiths, merchants, and scribes. And that's when something revolutionary was discovered. People rarely wanted all their wealth back at once. They used only what they needed and preferred the rest to remain protected. This meant the same assets could be loaned out to multiple people. Value no longer depended on what physically existed, but on what people believed existed. Banking quietly became an invisible contract built on trust. And when that trust broke, societies collapsed. Ancient debts sparked revolts, governments fell, and empires rewrote their laws to control interest, credit, and power. Because once money is created, it must be managed. Who gets to borrow? Who is considered trustworthy? And who is left out? Banking evolved from a simple storage service into a gatekeeper of opportunity. Still, the system kept growing. Records improved, credit became standardized, and contracts replaced handshakes. The world was approaching a much larger era, one where money could cross borders. And this transformation would turn banking from a local convenience into a global force. It would go even further when, for the first time in history, a single family proved that banks could control not just local markets but international ones. And from that moment, everything changed. The real foundations of modern banking were not laid on clay tablets in ancient times, but in the narrow stone streets of Europe. In the 14th and 15th centuries, as trade expanded, merchants needed a safer way to transport, protect, record, and grow their wealth. And at that exact moment, the family that would change the course of history stepped onto the stage. The Medicis. This Florentine banking family didn't just store money, they built power with it. Holy Roman emperors, popes, kings, all were clients of the Medici Bank, because the Medicis created a system so revolutionary that it redefined finance itself. The record of trust. The double-entry bookkeeping system showed that every debt had a credit, every expense had a source. Money was no longer just physical, it became mathematically traceable. This seemingly simple method became the invisible backbone of the global economy. But as their power grew, so did the risks. Kings borrowed but did not repay. Trade routes were cut off by wars and plunder, and interest rates inflamed entire societies. Money became both an essential tool and a dangerous weapon for governments. As a result, rulers didn't control banks. Banks became the entities rulers depended on. And for the first time in history, a financial system became powerful enough to shape the fate of nations. In 1609, the Bank of Amsterdam was founded, the world's first central bank in the modern sense. Here, coins were weighed, stamped, and tied to a single standardized value. This system created order out of economic chaos. Trade no longer relied on chance but on mathematics. London, Paris, and other major cities followed the same model. Banks became the official financial partners of governments. Taxes, war expenses, infrastructure projects, none of it was possible without banks. And at this point, a critical truth emerged. Creating money was not just about melting metal, it was about producing power. And little by little, that power slipped from monarchs into the hands of banks. The public still believed their governments were in control, but behind the scenes, the real switches of the economy were being operated by different hands. This new order laid the foundation for the modern financial empire. In the next chapter, we will see how this power expanded into a global network, one that transcended borders, armies, and even governments. By the 19th century, banking had surpassed local boundaries and spread across the world. Gradually, banking transformed into a global network. During this era, railroads, steamships, telegraph lines, and industrial production all required massive capital, far more than governments alone could finance. In fact, it was impossible for most states to fund these projects on their own, which is why they increasingly turned to private banks for loans. And at that moment, a quiet truth emerged. Whoever controlled the power to lend controlled the direction of the future. International financial institutions and major bankers built invisible credit, bridges across borders, linking London, Paris, Berlin, and New York. Heads of state signed treaties, but the real negotiations often took place at the tables of bankers. Wars, ports, railways, trade routes, all depended on finance, and it was the banks that decided which future would be supported. As wars grew larger, nations were pushed to extreme financial limits and took on massive debts. A country's chance of winning was no longer measured solely by the size of its army, but by the interest rates it faced. Money stopped being a simple tool and became a geopolitical weapon. As power grew, suspicion grew with it. People began asking, who truly runs the world? The governments we elect, or the banks that finance them? Yet the influence of banks did not arise from secrecy, but from necessity. For modern economies to function, they needed liquidity, trust, and institutional stability, and banks provided all three. Central banks multiplied, printing money, setting interest rates, regulating markets, and quietly shaping people's lives. A small monetary policy decision could increase unemployment, trigger inflation, or revive an economy. Citizens did not see these decisions, but they felt them at the grocery store, in their wages, in their home loans. At the same time, commercial banks grew stronger, encouraging people to take loans, invest, and consume. Society gradually became dependent on banks, and the importance of banking became an undeniable truth. By the early 20th century, banking was no longer just a service. It had become the operating system of civilization. And for the first time, financial crises spread like a virus from one nation to another, revealing just how interconnected the world had become. In the next chapter, we will see how this power reached its peak, lifting fortunes, collapsing economies, and ultimately shaping the modern financial order. The 20th century marked the beginning of a new era for banking, one that carried it into an entirely different reality. A world where money could move faster than governments could react. Industrialization, mass production, global trade, and consumer-driven economies expanded finance at an unprecedented scale. Banks were no longer just institutions that issued loans. They had become the architects of society itself, deciding which industries would grow, which companies would survive, and which dreams would turn into reality. But this power carried fragility. The 1920s became the golden age of speculation. Ordinary people poured all their savings into the stock market, driven by the dream of becoming rich overnight. Banks fueled this dream by offering credit for stock purchases and multiplying risks. And in October 1929, those dreams shattered. The market crashed, banks folded, savings evaporated, and the world plunged into the Great Depression. Humanity witnessed for the first time what uncontrolled banking power could unleash: global suffering. Breadlines formed in cities, businesses collapsed, and governments stood helpless. And at that moment, an undeniable truth emerged: banks were no longer just a part of the economy. They were powerful enough to destroy it. In response, nations rewrote the rules. Regulatory institutions were established. Deposit insurance was created, and the roles of central banks were strengthened. The Federal Reserve, the Bank of England, and similar institutions became guardians of the economy. Yet, stability created a new dependency. Banks and governments became inseparable. When a crisis erupted, the public rescued the banks. When governments needed funds, the banks financed them. Boundaries blurred, power merged. After World War II, a global financial order was built. The IMF, the World Bank, and later the World Trade Organization began directing international money flows. Capital now knew no borders, accelerating growth but also spreading crises. A collapse in one country could ripple across the world within days. Banking had entered an age of mutual interdependence. Meanwhile, personal banking expanded. Mortgages, consumer loans, credit cards, borrowing became normal. People no longer just earned money. They bought the future in advance, and at the center of it all were the banks. By the end of the century, financial markets had grown so influential that stock market swings could shake governments, currency fluctuations could cripple economies, and corporate mergers could render national borders irrelevant. Banking emerged from its dark history even more powerful, becoming the invisible operating system of the modern world. And now comes the digital age, where money transforms from paper to data. Investments are made by reading numbers on screens. Banks no longer need buildings, and finance is quietly governed through streams of information. By the early 21st century, the very nature of banking had changed, becoming more invisible, more complex, and more powerful than ever before. Money no longer needed vaults, armored trucks, or marble counters. It lived on servers, databases, and encrypted networks. With a single click, capital could move across continents, effortlessly crossing borders that once defined economies and restrained even the strongest governments. Banks transformed into digital ecosystems intertwined with tech companies, investment funds, data centers, and global markets. But this transformation was anything but quiet. In 2008, the world discovered, painfully, how deeply banks controlled the global economy. Risky mortgage loans, complex financial products, and unchecked greed triggered a catastrophic collapse. Lehman Brothers fell, markets crashed, and millions lost their jobs, homes, and savings. Government stepped in once again, this time not to save the public first, but to rescue the institutions deemed too big to fail. And humanity learned an unsettling truth. When banks fall, nations fall. After the crisis, trust was broken. Yet banking power did not shrink. It evolved. Regulations tightened, but financial innovation accelerated. High-frequency algorithms began executing thousands of trades per second, moving markets at speeds no human brain could process. Data became the new currency. Banks analyzed spending habits, risk profiles, travel patterns, turning personal information into economic leverage. Meanwhile, a challenger emerged: fintech, digital wallets, online lending platforms, payment apps, and the world of cryptocurrency began, questioning a centuries-old banking monopoly. But banks didn't disappear. They adapted. They invested in technology, explored blockchain, and expanded digital services. Today, algorithms approve loans, robo-advisors manage investments, and AI agents who never sleep handle customer service. Banking power has grown quieter, faster, and more invisible. And yet, one truth remains unchanged. Whoever controls the flow of money controls the world. Banks still sit at that intersection. They stabilize or destabilize economies, decide which industries thrive, and determine who gets opportunity and who is left behind. Modern banking no longer asks, "How much money do you have?" Instead, it asks, "What does your data say about you?" In the final chapter, we'll confront the ultimate question. If banks can shape economies, governments, and even human behavior, then who shapes the banks themselves? And in a world where everything is influenced by capital, who truly owns the money, even after thousands of years? We return to the same question. Who truly owns the money that governs nations and shapes the world? On paper, banks are institutions meant to serve the public, regulated by governments, accountable to the state. But in reality, banks function like the main arteries of civilization. They decide which countries advance, which societies grow, and which ones fall behind. Power didn't disappear. It simply changed form. It no longer wears a crown or carries a sword. It lives in boardrooms, interest rates, credit approvals, and digital ledgers. Central banks operate like silent monarchies. One announcement can sway inflation, unemployment, elections, even global politics. Commercial banks determine who becomes a homeowner, who starts a business, and whose dreams are cut short. Investment giants can shake entire markets with a single move. Firms like BlackRock, Vanguard, and State Street control more assets than many governments. The true owners of capital rarely appear in public, yet their influence exists everywhere. And still, despite all this power, one truth remains: banking is built on belief. When people lose trust, even the strongest institutions collapse. History has proven this, from ancient debt uprisings to modern bank runs. Technology hasn't changed that rule. Today, algorithms approve loans, AI predicts markets, cryptocurrencies challenge banks, and digital payments reshape the system. But behind every line of code are human emotions: fear, ambition, hope, courage. Maybe the real question isn't who owns the money, but whom does the money own? When society measures value by data instead of labor, when opportunity is distributed by credit scores instead of potential, when finance becomes more important than human life, then money becomes the master. But it doesn't have to. Banking can be used for good, to fund cures, education, clean energy, science, equality. Capital can unite instead of divide. The system is not destiny, it is shaped by people. Because money never truly belonged to the banks. It belonged to trust, cooperation, and imagination. And those still belong to us. That's why the future of finance isn't in the hands of banks, governments, or algorithms alone. It's in the hands of people who demand fairness and transparency. Maybe then the world will stop asking who owns the money and start asking who deserves it. Now it's your turn. Do banks serve humanity, or does humanity serve the banks? Share your thoughts in the comments, because this conversation may shape the future of finance.